Hi, everyone. Thanks for joining us. Today, we're here to talk about tax smart compensation planning for business owners. This is one of the topics that we get a lot of questions on, and an area that we oftentimes consult with the tax professionals that are assisting our clients as well, because there's many different areas of financial planning that we assist with that also cross into tax filing and the payroll side of the house as well. So, very excited to talk through a lot of the different areas today with everybody on our webinar. Thank you again for joining us. Joining me today are my co-hosts, Drew Allen, Senior Wealth Advisor here at Instrumental Wealth, and Brian Lydell, CPA, shareholder at Kirkering Barbario. So thank you for my co-host here in joining us. And I want to go ahead and jump right into our agenda today. First and foremost, we're going to talk about compensation strategies specifically tied to how you're paying yourself from both a K-1 as well as a W-2 salary. Next, we're going to jump into family compensation planning. So Drew's going to take us through that as well, understanding aspects like paying your spouse, paying your children. What are some things to kind of consider here, and how this also all comes together in conjunction with other areas of your financial planning. Next up is qualified plan design. Brian and I are going to talk through that and how paying yourself and adjusting how you pay yourself can affect the different nuances of designing a qualified plan, and conjunction with that on a defined benefit pension plan. And then lastly, we're going to walk through charitable considerations as well when it comes to your compensation. Lastly, we'll address Q&A. At the end, if you have questions, please submit them into the Q&A section, and we'll be happy to address those. We've already got some questions here from everybody attending, so thank you. Continue to submit those. Okay, let's jump into it. So K-1 versus W-2. So this is, for those that aren't aware, just sort of a quick high-level overview here. My W-2 salary, if I'm owning the company and I am an S corporation, I am able to pay myself a W-2 salary. We're going to come back to talking about how this ties into a qualified plan in a moment. But essentially, the way that a W-2 salary works is that as the owner of the company, I am both responsible for the employee and the employer portion of the payroll tax. So that's the 15.3% of payroll, percentage of my W-2 that goes towards that payroll tax. And then on top of that, I have my normal federal income tax on top of that. Okay. And so clearly, when we look at this compared to a K-1 from an S Corp, which does not have the same payroll tax associated with it, but we do have federal income tax, we want to be mindful of how much we're actually paying ourselves from a W-2 salary perspective, because every dollar that we put into our W-2 increases our payroll tax. On the next slide, we actually have a nice flow chart here that breaks this down. I know this might be a little difficult to see here. Everyone attending this webinar will also receive the recording of this, and as well as the slide deck that accompanies this. So you could zoom in a little bit more, but effectively what we've tried to do is illustrate how this works. So you'll see at the top of this, you'll see paying yourself with W-2 or K-1. You'll see on the left-hand side from that W-2 an example of what's reported to the IRS, a retirement plan contribution as well. can be made only out of the W-2 income. So this is something to be really mindful of for those that are trying to optimize the relationship between their payroll tax and their income tax, as well as one of the areas that they can really get some nice deduction through a qualified plan design, particularly with elective deferrals, those deferrals are affected by what you are paying yourself in W-2. And so this is something to be very mindful of. Of course, I know this may be difficult to see, so I won't make everybody strain their eyes and look through. But on the left-hand side, this talks through really the breakdown and the allocation. It is a nice visual for everybody who's interested in understanding this concept a little bit further. On the right-hand side, you'll see the K-1. And again, the advantage of your K-1 here is that you avoid paying payroll taxes on that. So you can save yourself a fair amount of tax simply by saying, in this example that we have here with the client, they have $500,000 of total compensation. They've got many different ways that they could pay themselves, but if you paid yourself all W-2 for that $500,000 of total compensation, that's going to not only get payroll taxes on it, but also federal income tax, versus if you split that up and you said, well, I only want to take $150,000 out as a W-2 and the other $350,000 I want to take out as a K-1, then you are able to save the amount of tax that's owed for the payroll tax on that K-1. But Brian, this actually leads me to something that I know you deal with a lot, which is reasonable salary considerations. I've had many clients, when we explain this concept to them, say, well, David, why wouldn't we just take it all out, or the vast majority of it? Why wouldn't we just do $25,000 of salary and then the other $475,000 is K-1 if that saves me taxes? And my response to that is, well, there are things that you have to do here with the IRS from a reasonable salary consideration perspective. I know you dealt with a lot of audits over your time frame as to what's reasonable compensation and what's considered reasonable compensation for the IRS for your profession. So maybe you can help everybody understand from a CPA perspective in dealing with the IRS some of those nuances.
Sure. Ever since the S Corp came into existence, folks have been trying to figure out the best strategy for saving the payroll taxes. And one, obviously, as Dave mentioned, is, why take any salary at all? Why not just take all as K-1 distribution? The primary reason for that is that the IRS requires reasonable compensation. Now, they don't define reasonable compensation. It's all based on individual circumstances. We've seen a number of audits, a number of court cases in this area. And really what they're looking for is they look at your profession, your area of the country, but primarily they're looking at what else are you taking out from the company? Are you taking distributions of, 100,000, a million, 10 million? That compared to your salary is where they start their analysis. So what not necessarily triggers the audit, but they will compare your W-2 salary to your distributions from the K-1. And in many cases that may trigger an audit. And we've seen it where, someone that may be paying themselves what they consider a reasonable salary gets examined. IRS comes in, says, no, it should be X amount. Well, now the burden goes back on the taxpayer to prove that this is what they took was reasonable. In cases we've seen, one where there was an attorney who took a $300,000 salary and $5 million in distributions. IRS said, no, you should have a much higher salary. Came back, went to all the way to the tax court. Tax court said, no, $300,000 is reasonable for an attorney in that area of the country for the type of law they perform. Actually, we had a case here where a CEO, actually the owner of a company, was paying himself a salary of $40,000 and taking $2 to $3 million a year in distributions. IRS came in, said, nope, that's not reasonable comp. So they said, you need to take a higher salary. He showed them that he actually was paying a full-time CEO, a full-time CFO, and he spent most of his time on his boat. He showed them records, how often he was taking the boat out. They said, okay, we understand you're not as active in the business as you used to be. 40,000 is reasonable. No change to that taxpayer. Now, the court cases that, we generally see go all the way to the tax court and get disputed are when someone takes zero or some minimal salary, 10,000, 15,000, 20,000, and they're taking over 100,000 to 500,000 in distributions. That's really the balance there, is to make sure that your compensation is reasonable for your profession in your area. Now, the cases we've seen, they've come in, they've taken someone from zero comp to 80, 90,000, and they've let them still take 200 or 300,000 in distributions. So we use those cases to formulate our thoughts on the balance between the two. Again, later on, we'll discuss, you do want these W-2 wages as well for retirement planning, defined benefit, defined contribution type plans, as well as one thing that's not on the slide. There's also a balance between the qualified business income deduction requires that your company have salaries, not for the owner, but overall salaries. So there is an opportunity there to increase salaries to balance and maximize the QBI deduction. Now, we didn't put that on the slide as the math there gets too complex, and we didn't want to bore you with that. But definitely something to talk with your advisor about. Now, all of this relates to S corporation planning. Now, if you have an LLC that is taxed as a partnership, these rules, these methods don't this doesn't come into play because an LLC does not pay taxes as a partnership, does not pay its owners a W-2 salary. Now, one of the strategies there is to take all of the partners in an LLC and for them to each create their own S corporation. Now they're back in control of what their compensation is. Now, generally, even though they're all individual S corporations that are partners in a partnership, they do all have to combine as part of the retirement plan. They're all folded back in with the main company, but they each are able to determine what their compensation will be from a W-2 perspective. We see this a lot with professional practices, law firms, engineering, architecture, accounting. In that case, you have, so let's say one or two partners are outperforming other partners. Well, they may want to take a higher salary and the others may want to take a lower salary. So this doesn't constrict you to just the partnership rules where every dollar is taxed for self-employment tax. Again, another strategy there is potentially looking at a PEO that handles your payroll through the partnership. Technically, there needs to be another company involved, but there are multiple ways to get around the self-employment tax from a partnership perspective as well.
Awesome. Brian, that was super helpful. Lot of great takeaways there. My W-2 as a percentage of my K-1, what that relationship generally looks like is really important. There's no black and white math there, but you have to be mindful of that in designing this. Secondarily, LLCs and partnerships, there is a difference there if you're not an S corporation, and factoring in the qualified business deduction is important as well. And then the last thing I heard, I'm pretty sure, Drew, you got this as well. I think we need to spend some more time on a boat. That way we can justify paying ourselves a little less. But all kidding aside, that was super helpful, Brian. So Drew, let's talk next here. I know about family compensation planning and how maybe paying your spouse, paying your kids can also be an area to sort of focus on when it comes to tax planning.
Sure. Yeah, we get this a lot. We have a lot of clients, business owners that ask us questions around paying their spouse, paying kids. And so let's dive into this, because it is a topic we talk about a lot with clients. And so what does it look like? First and foremost, it's probably the easier one to talk about is paying a spouse. What does that look like? So your spouse would have to have some level of a material contribution to the company, right? You can't just put them on payroll and they don't know anything about the company. They don't do everything with the company. I am married, and I know my wife probably gets tired of hearing about what I'm doing at my office. So there's a lot of conversations that we would consider pillow talk that just kind of happen around running a company anyway. But are you documenting? Do they have a role? What is that role? And having some define or definition around that, no different than you'd have an employee with a job title and responsibilities. Coming up with what that looks like. Now that can be pretty broad, but it is something that you would, in case of an audit, you would need to have that documented. So the other important thing would be, again, a lot of higher income earners, business owners, that W-2 compensation we just went through for a retirement plan contribution. Maybe you do have a spouse that you have on payroll that is a stay-at-home husband or wife, and at that point we put them on there so we can make employee defined contribution or 401k contributions for them. They would need to be on payroll for you to do that, and that could obviously help with a tremendous amount with tax savings. A little component here, and if we go back to the slide that we bring up with clients, is because we do have a lot of folks that have a spouse that maybe stays at home, and maybe they have some help, a nanny, after school care help, et cetera, and they're looking for a deduction for paying that, let's say nanny in this case. There's, and Brian can touch on this a little bit more in detail, but the reality is if they don't have a W-2 wage, the IRS would say, well, why do you need to pay a nanny if your job is to raise those children? So it's a little nuance there for that tax. If you're looking for that credit, that dependent care credit, they do have to have a W-2 wage. So it's another reason to maybe have a spouse on payroll. So jumping into paying our kids, this one we get a lot. I think in the past, we kind of talked through it quite a bit, because with the advent of social media over the last few years, and this seems like it's everywhere. The guy or gal who's probably not qualified to even tell you to put your kids on payroll is doing a 30-second TikTok telling you to put your kids on payroll. But let's talk about what that means. First, again, just like with a spouse, there has to be documentation. If you have a 5-year-old, they're probably not doing a lot of filing at the office for you. So what does that look like? And it's got to be age appropriate, and you have to document it. And so we make sure clients do have, whether it's marketing or whatever you want your child to help with, which my kids probably know more about social media than I do at this point. So that would actually make sense. And I have a 16-year-old that is helping me with social media. Again, putting that in place, how long have they spent doing it, and putting that there. So when it comes to paying our kids, that is the documentation, reasonable compensation. And I really want Brian to kind of jump in here to say, what have you seen? Have you seen tax law court? What cases are out there regarding paying children? And then kind of walking through an example that we have on an additional slide here about what would that even look like? How much should you pay them? And what could you do with that pay after that? So Brian, talk a little bit about maybe some audit triggers or compliance issues, and expand upon that a little bit.
Sure. I mean, really, in this area, there's not a lot of audit triggers, as this is going to look like normal W-2 compensation flowing out of your business. So what's going to trigger this is if upon an audit for some other reason, or just a random audit, they're looking through your W-2 compensation, they see your kids' names on there, they say, hey, well, tell me about this. What are they doing for the business? And really what, as Drew said, the documentation, what you want to do is you want to go through all the normal procedures you would for a regular employee. You want to make sure you're paying them on a regular basis. You're documenting what they're doing, and also make sure what they're doing is for the business. The cases we've seen, when they go back and look at records, it's paying the kids for cleaning the pool or cleaning up their room. These aren't normal chores that you're paying them for through the business. It's something related to the business. And really just, if you go through the kind of the mechanics like you would for any other employee, you issue them a W-2, you're doing, all the even a timesheet would be great. The more documentation, the better if you do get, picked for exam by IRS. Now, reasonable comp for the age and the work, again, Drew said they have to be doing something in the business, but that's just pretty flexible. You've got younger children can potentially be models for social media or other advertising campaigns. If you can imagine, picture a TV commercial you see with a personal injury attorney and his kids are running around the backyard. I guarantee you they're all being paid for that, and that money is flowing through the business. They're putting money into retirement based on that. It's being done, and in that case, obviously, that's very easy to document. We do have a few cases where IRS has looked at this and said, okay, what does your kid do for the business? One CPA employer mom said, well, I leave my kid on the phone when I'm on hold with IRS. And then when she comes and runs and gets me when you actually pick up after an hour, that's what she was paying her kid for. Again, the modeling is very popular. Filing at, whatever age, not 8, 9, 10, there's definitely kids out there that can do that. But again, make sure you're documenting this. You're putting something down on paper, putting in your file, paying them. And then, really, again, like I said, there's nothing special about the way you're reporting it that's going to trigger an audit. You're issuing them a W-2. They're going to, the strategy is to keep them under the threshold for having to file a tax return. Even better, if you're a sole proprietor, Schedule C, or a husband-wife partnership, kids under 18, you don't owe any payroll taxes on those kids either. So even a better scenario than even with the just normal compensation deduction. Again, from that compensation, they can turn around and make contributions to Roth IRAs, potentially other retirement plans. And again, to get that started at a young age is something we've seen where the IRS, congressional push is to have people save for retirement. So in this case, having kids starting to save at an early age, this isn't something where the IRS is attacking this. What they're going to attack is just the unreasonable pay for work that's not being done for the business.
Yeah, that's Brian. Thanks for walking through that. And I know that my daughter will be very happy to know that maybe she could be now classified as a social media influencer since she's helping with that. I think you just made her day. But so W-2'd, the children are W-2'd, make sure they're under the threshold on filing a tax return. And so, Brian, what is that? I mean, a lot of clients are probably saying, hey, what is that number? I mean, you're mentioning this number. What would that number be?
Well, for 2025, it's $15,000. So if you're $15,000 of earned income, anyone doesn't matter what age, but anyone who has less than $15,000 of income as an individual single filer does not have to file a return. Again, if your kids have other jobs, they may still, you might want to file those returns under $15,000 if there's any money coming back. But in this strategy, you would pay them up to that $15,000 with no withholding and no federal income tax withholding. They wouldn't need to file a return. It's a deduction for your company, so really win-win. You're out a little bit of payroll tax, but not compared to what you're saving on the income tax side.
Yeah, no, that's great. Thanks for kind of clarifying a number. And we talk a lot about the triple benefit with paying your kids. And so from that, the aspect of you getting a deduction because you're paying them, it's going to them. They're not having to pay the federal income tax on it because it is below the limit. We don't need to file that return. And then rolling to, and if we show the next slide there, you could do things such as putting that money into a Roth IRA, potentially funding other vehicles. And again, you'll have a copy of this in the follow-up slides and kind of walk through that. And we're happy to talk more in detail one-on-one with folks. But Again, Brian, great job on that. It's such a benefit to get a deduction, be able to put money away for the kids, them not have to pay, and have your kids work, actually do some work for you for once. Well, anyway, thanks again, Brian, for talking through that. So we're going to kick it over. Dave, let's talk, shift gears a little bit to qualified retirement plan design. Walk us through some topics on that discussion.
Yeah, absolutely. That was great, guys. Super helpful. I know that there's always a lot of stuff around this on social media. So great job addressing that. So yeah, absolutely. Qualified plan design. I know I touched on it at the beginning part of the webinar today, but one of the biggest areas for small business owners in particular to find additional deductions is through the use of a qualified plan. And there's many different types of qualified plans. We're probably all most familiar with a 401k type option, and we're going to talk through how that works here in a moment. But there's a few other ones to make mention of, like a SEP IRA, a simple IRA, and you know, all of those are great options. We're going to highlight the 401k in particular today, but those are great options as well. They're a little more nuanced, and they could make sense for the right situation. But generally speaking, where we see a 401k plan come into play, and more or less the benefits around this is for clients that are in really about a mid 20% tax bracket and higher. We put in the slide here those in a 30% bracket. Certainly, we'll talk through this a little bit. There is some administration here and some cost around administering it, as well as your time and staff's time for administering a 401k in particular. But there are some really great ways that you can reduce your income tax burden by the use of a qualified plan. So I'm going to use the example that we had on one of the previous slides of someone that's making $500,000. They're able to take compensation both through W-2 and K-1, a combination, whatever that combination may be, of $500,000 per year. Generally speaking, at that amount of income, they're going to be approaching that sort of mid to high 20s federal income tax, just from that amount of compensation, not including the 15.3% that would come out on the W-2 side of the house. Okay. And so the real easy concept here is if you have the choice to make between paying yourself W-2 and a K-1, we obviously want to reduce the amount that we're paying ourselves in W-2 salary because it reduces our payroll tax. However, everything that is around a qualified plan design is really around how much your W-2 compensation is. And so we want to be mindful of, we like to refer to the analogy of a seesaw, where if we pay ourselves more in W-2, we're increasing our payroll tax, but we can offset that by a qualified plan design, particularly with elective deferrals, profit sharing contributions, et cetera. And so really what we like to just break this down into a really simple math equation is if I'm going to do a qualified plan, I need to make sure that I pay myself enough salary, W-2 salary, to then be able to take advantage of the deduction both on the employee and the employer side. That's why we generally say sort of mid-20s, because the easy math here is if I need to increase my W-2 compensation, that's going to increase my payroll tax 15.3%. I better have enough tax arbitrage on the other end of it through the federal income tax deduction to make the juice worth the squeeze effectively. So if I'm in that example of paying myself $150,000 of W-2, I'm incurring 15.3% payroll tax on that. However, I'm able to take the deduction, particularly if you're in a very high tax rate, the highest federal rate of 37%. I'd rather pay 15.3% to the IRS in payroll tax to then save 37% because I'm getting that tax arbitrage. And so that's why we generally say you really want to be approaching that sort of mid 20% tax rate or higher, because you have to make sure the juice is worth the squeeze here. So there are other opportunities here outside of a 401k where particularly Drew talked about paying your spouse and making a qualified plan. I know, Brian, you're going to qualified plan contribution for your spouse. I know Brian's going to talk through that a little bit here in just a moment. But the last piece that I want to mention here, as far as the other types of plans, is a 401k plan does have some admin expenses for someone that's just trying to do something here. One of the great options here, if you just want to keep it simple, no pun intended, is a simple IRA. One of the nice things about a simple IRA is it's straightforward. You're able to contribute a little bit less on your elective deferral, but the match piece is very similar to what we generally see in a safe harbor type of plan. And it can really be a nice entryway into this type of retirement plan, qualified retirement plan design, particularly with how you're paying yourself and potentially a spouse. If you don't want to deal with a lot of the nuances with profit sharing and potentially adding a defined benefit plan on top of it, can be a really nice entryway into this type of planning. So, Brian, why don't you talk to us about paying your spouse and some considerations there, as well as using your W-2 for the actual retirement plan contributions?
Sure. Really, we mentioned paying spouse and children prior. Now, one of the other factors into that is this potential for additional qualified retirement contributions. With a spouse or a child, you can pay them a very minimal amount and still potentially, utilizing a 401k, defer quite a bit of that salary directly into the plan. So, with a 401k or a simple IRA, you have a salary deferral option, which you can put the first, say, $16,000 to $23,000, depending on the type of plan, depending on your age. You can put that money directly into the plan from the first dollars of compensation. So often we see a spouse with, somewhere in the $20,000 to $30,000 W-2 compensation range in order for them to be able to make that full deferral to the 401k. Again, the matching component, if there's a safe harbor, if there's a profit share, that's all going to be based on the W-2, gross W-2 wages. So there may be a very small component there for a spouse that's not as active in the business, but that $23,000 or so that they can defer right into the plan, that can be a huge benefit for them. And again, for you as a deduction for your company. Same thing with the kids. They're able to, put those first dollars into these plans once they're added to payroll. That's really the key point there. Again, using the W-2, it's that balance we talked about, having enough W-2 wages to be able to maximize your contribution to the plan. 401ks can be very complex in the allocation of, the safe harbor, employer match, the profit sharing piece, the potential for a defined benefit type plan add on to it. But really the basic components are getting the maximum deferral in and also maximizing you as the owner, maximizing your contribution to the plan. That has to be done through proper W-2 planning as well.
Super helpful. So I think there's a lot of great takeaways there, Brian. One of the things that I'm reminded of is even in my own situation, there were some things that I was actually having my spouse do for the business prior to adding her to payroll, where she wasn't actually getting paid for them. Things like organizing our holiday party and things that she does just because she's a lovely wife. But before, we weren't putting her on payroll, and by adding her to payroll, not only could we then get the child tax care credit, but then she was able to defer that to her 401k, and we were able to get some larger deductions there. So a lot of great takeaways. And for those that are listening, I think if your spouse is helping you with certain elements of the business, I think there's a really easy way to justify adding them to payroll as well. So very, very helpful. A lot of great takeaways there. So we talked a little bit about 401ks, simple IRAs. One thing here that Drew's going to take us through here in a moment is adding another element to that, where this is really designed for clients that are looking for some deductions on top of that. And so, Drew, why don't you walk everybody through how adding on top of a 401k plan, a defined benefit pension plan, could even add more to their ability to find deductions.
Yeah, absolutely. So this is a big area for a lot of folks, a lot of business owners that, in an example where someone's making well into the six figures, possibly even seven figures plus, a lot of times they don't get super excited about a $23,000 deferral, or if they're over the age of 50, a $30,000 deferral. So they still have a lot more capacity to save. Brian mentioned the safe harbor, so that adds the employers kicking that in, which essentially is themselves because they own the business. But what else can they do? And so a big part of that is adding this potential for a defined benefit pension plan. These calculations are a lot more intricate. They're done by actuaries that are going to take into account length of time of your working career as well as life expectancies, and there's an actual calculation. So again, it's really important to understand what Dave was talking about. What do we pay ourselves on that W-2? Because the IRS is going to want to see that you've paid yourself a wage, most likely in this case with a pension, up to the maximum IRS compensation number for the year, which is probably somewhere, it was 345 last year. It's indexed up again. And so once we've eclipsed that, you can start to put away, in some cases, $200,000-$300,000 more, depending on your age, in these plans, because it is done through an actuary. It's reviewed. Forms are filed with the IRS each year. So it follows a very strict guideline on how it's done. And typically where we see this a lot is maybe you've done very, very well financially and make a great income, and maybe you have a small staff. So we'll see this a lot with real estate brokers, where maybe a lot of the folks that work with them are, they're not on payroll technically because they run their own businesses. And maybe they have a spouse inside the business and maybe one or two staff folks. Because when you add one of these defined pension plans, you also must do things for your staff. It can't just be for you as the owner. So again, they get more intricate. But when you look at a couple who own a business, being able to defer sometimes $300,000 or $400,000 or $500,000 more out of their income, and if you're in a 37% bracket on those dollars, that's a substantial tax savings. So that tends to get business owners excited beyond the $23,000 or $30,000 number. That is where we typically see those scenarios. We still will see them with folks that have very large employee banks as well, where they have a good amount of employees. But you have to be pretty generous with your team, because the IRS is saying, if you're going to take this big benefit, we really want you to help the folks that are helping you with the company. And so that's not a bad thing. That's a good thing, but we just have to be mindful and run those calculations. So Brian, what is your perspective on that? I know you work with a lot of business owners that do very, very well, that are always asking these questions. They may get approached about something like this, but where do you see implementation on these things is in your practice and just in general?
Yeah, I mean, like you mentioned, with a single owner, one employee type company that's generating, substantial net income each year. These are very easy to explain and implement for them. Now you've got husband and wife, the same thing. They're very happy to put that money away. When you start to add staff members, they start to worry about what is it going to cost them in the long run. Are they committed to a certain number of years of funding this? What happens when they add a new employee? Do they all of a sudden, their total contribution to the plan, how much of it is going towards their account and versus their employee's account? And not that not that they don't want to be generous, but they want to make sure that they are maximizing their, this plan for their benefit, rather than, the cost that they're incurring. Is it going to be detrimental to the business from a cash flow perspective? And really the thing we see is that as their staff grows, the complexity of the calculation maybe gives them some pause. I generally try to tell them, there's a lot of ways that these plans can be designed. If you have younger staff, it's still going to be more heavily weighted towards you as the owners. If you've got a small staff or a lower paid on average staff, again, it's all based on everyone's compensation. So there is still that potential to put the bulk of these contributions toward your accounts based on plan design. Now, I've seen a few where it just didn't work out. They didn't want to commit to those dollars for that number of, for a few years. But in many cases, like you said, Drew, $200,000 to $300,000 in addition to the maximum kind of 401k standards that we see that can be put away in these plans. And it's mind blowing to see they're faced with, they've never heard of these plans. They all of a sudden have this ability to put away that much more into their retirement. Maybe they thought they were behind at some point in total funding. They're getting that into these accounts, tax deferred, and it's really, on the downside, like you said, it's a little bit more work on their part to get it up and running and implemented. But once it is, it's a great benefit.
Yeah, absolutely. Well, thanks for going through that. How does this? Let's say I'm not an S corp. Let's say I'm a C corp. Talk a little bit about how this would affect someone with a C corp and some of the specifics around a C corporation.
Yeah, and we used to see, C corporations almost all went away when the S corp option came into play. There was no reason to pay double taxation. You'd have the corporate tax layer one, you dividend that income out to the owners, then they pay another layer of tax. You're well over 50% in total, effective tax rate. People shied away from the C corps. Now slowly, partly because the tax rate on C corps has dropped to 21%. And also there's a couple other factors that people are now getting back to the C corp model. One of those is this kind of relatively unknown qualified small business stock, 1202 stock. Very complex rules around this, but essentially, if you are originally issued stock from a C corp, there's a potential for excluding the gain on the sale of that stock after a 5-year holding period. You can exclude the gain on the sale of that stock. It's up to 10 times what your basis in that stock. The numbers are, it potentially could be $500 million of gain that the original owners of a C corp could exclude from their tax, that is sitting here in this 1202 rule that very few people know about. It's great for startups if you feel like there's a potential for this company you have to really take off and grow. And again, it's the C corp model is there's not many that are familiar with it, but compensation wise, very similar. You're looking at, you pay yourself these salaries to maximize qualified to retirement plan contributions. In the C corp setting, there's also a reasonable compensation rule regarding taking too much compensation. Now, that hasn't been the case as much since the tax rate went down to 21%. It was before it was used. Folks would bonus out all the net income of the C corp in order to avoid that double taxation. But now with the rates back into a better mix, it's not as common. But again, C corps are not to be I'd say definitely talk with your tax advisor about the potential for a C corp if it makes sense in your situation.
Yeah, great. Thanks for walking through that. And again, if you are a C corp, like Brian said, talk to your tax advisor. Reach out to us. We can connect you. Very interesting rules there. 500 million's a big spot to save some money there if that's you. So let's jump into our last topic here. Dave, walk us through charitable giving considerations and what we typically are seeing in the marketplace there.
Yeah, absolutely. Absolutely. So one of the biggest things to be mindful of, if you are charitably inclined, whether it be to a charity, a church, a lot of our clients use donor advised funds as well, is to be mindful of the limits as a percentage of your total compensation when it comes to your ability to give. And so we've got this chart up here for those that are interested in what those are here. I won't necessarily call them out each right now, but they're in here for you guys to reference. But this is probably one of the biggest areas to just be mindful of if you're typically giving to charities, whether it be a public charity, whether it be cash, whether it be appreciated stock, private foundations. There are AGI limits in here to be mindful of. And so, Brian, I know that you've got a lot of experience here with sort of how to, what we like to refer to as dance between raindrops here with sort of balancing this out in some situations that you've seen and some opportunities here to be mindful of. So maybe you could walk us through some of those.
Yeah, definitely. It's, we see this a lot in, as you mentioned here, the income spike years. To really look at charitable giving as a potential for saving, quite a bit of tax. Now, when you look at the percentages here, 30% of AGI for contributions to certain private foundations, 60% of your AGI for public charities. Now, I don't have a lot of clients that are giving away 60% of their income every year or running up against that limit. But in the case of clients that have maybe sold a business, received a stock option payout, they're looking at anywhere from $2 to $20 million in additional income. They are charitably inclined, but maybe they don't have a charity in mind, that they want to give that directly to that year. So what they do is they utilize a donor advised fund or potentially a private foundation that they create themselves to donate this money, take the tax deduction in the current year, and then it gives them some level of control over where that money goes, which charities it goes to over the next, into perpetuity. Really, if you have a foundation set up right, a donor advised fund could potentially last for many years, as you're only giving away a minimal amount each year, 5% of the total, to the qualified charities. And that those accounts keep growing, similar to in any other investment account. Now, again, you say I do see these AGI limits come into play in those situations. I've had folks who have sold a company, they wanted to maximize their charitable deduction, and you would think that if you sold a company, a lot of that's capital gain income, so that's at a lower rate. So, do you really want to contribute money to charity to only save, let's say, 20%? On your capital gains? Well, a lot of these company sales involve assets that may have been depreciated, so you have a higher tax on these depreciation recapture involved in the sale. Again, that's something to look at. So now you're saving at a much higher tax rate. Best scenario, is let's say it's all stock options that vested. It's added to your W-2. You've got couple $1 million in a higher income, you're well into the 37% ordinary income tax bracket. Potentially look at a charitable deduction, charitable contribution here. And again, there's many ways to do it, from a direct gift to these donor advised funds, or even potentially a private foundation. Just like the 401k, though, the private foundation, you have more control, but
I think we might have lost Brian there temporarily.
Nope, it says I'm back. You hear me?
Okay.
Okay. Again, as I mentioned, 401ks, just like the 401k, the private foundation comes with some cost for setting it up, applying with the IRS. And again, there's an annual tax return you file yourself, and a very small excise tax that you pay on the earnings of the foundation. But again, it's very can be very beneficial to maintain that control over your funds.
Very, very helpful, particularly around charitable giving. And to your point, Brian, I certainly don't see this from our end either, with clients contributing 60% of their income to charities. But in those years that they sell their company and want to be charitably inclined, it's
Looks like it might be round robin. We lost Dave now.
Yeah.
Oh, he's back.
Can you guys, I just said it lost my connection. Can you guys hear me?
We can.
Okay. All right. Sorry about that. I guess we're all having technical issues here with the internet. But just going back through that, because I'm not sure where I cut out. If you are selling your company, you have an LOI, you're thinking about selling your company, definitely want to be mindful of what you're paying yourself, and work with your CPA, work with your wealth management advisor to coordinate that planning opportunity, because there may be something you could do now prior to maybe save some money on some tax. So super helpful. So that concludes our agenda for today. We do have some time here, about 10 minutes or so left for some Q&A. And I know that we had a couple of great questions come in. First and foremost, yes, we are going to send the slide deck out to everybody, as well as a link to the recording. So be on the lookout for that. And as you guys have additional questions, on the bottom right-hand corner of your screen, you'll see the questions there. So feel free to submit those questions in that area of the webinar. The first question that we had was around, is the K1 versus W2 balance the best place to start with all of these strategies? Or can I pick and choose which one to do, like paying my spouse, my children, etc.? Brian, do you want to tackle this one?
Yeah, and really, it's you want to look at all of these. You're again, if you're paying your spouse, your children, your K1 income is going to be a little bit lower, so you'd have to factor that into the K1 W2 balance then. So you're looking at all of these kind of in total, and what kind of impact they can have on your total. At the end of the day, it's really, how much tax are you paying? You want to pay less. These are some ways to do it. And really just, you want to look at all these factors. If you're in the situation where you have kids, you're married, you want to potentially look at this. Maybe it's too late for the prior tax year, but look at it, prospectively. But you want to work at, integrating all of these into your plan. So really, it's not one or the other. I'd say look at all of these. If one of them doesn't apply to you, then just look at the other 3-4 potential strategies. And then at the end of the day, the K1 W2, very good planning strategy is, you don't have to decide on that until the last day of the year. If you control your payroll as the business owner, you can bonus yourself an additional payroll on 12/31 every year to come up with the exact ratio you want.
Perfect. That's super helpful. I'm going to stay with you on this next one, because this is certainly an area that you could speak to. So the question is, for paying your spouse or child, can you just make up an hourly rate that most quickly gets them to the $15,000 mark, or do they need to do some research on like what's reasonable from an hourly wage perspective? And is there like a verified IRS site where the ranges would be acceptable?
Well, I'll say no to the verified IRS. You know, they're not good about giving numbers or defining a lot of these terms. They like to keep it vague for their purpose. But you know, it's reasonable is what is in your area for that type of work. I mean, $15 an hour is it $20 an hour? I'd say don't pay your kids $50 an hour if your normal staff is making 40. It's if for some reason maybe if they were a little bit older, they're designing your website, maybe then you can pay them $50 an hour or $100 an hour for that. Just what type of work is it, and look at comparables. Again, the IRS isn't going to get too detailed into this unless you really just go off and you say I'm going to pay them $500 an hour until they get to 15,000. So that again, don't go with the extremes. Really just try to keep it within a normal realm of how would you treat a normal employee in that situation. Again, a neighbor's kid walked over and said, hey, can I file for you? What would you pay them? Keep it within that range.
Very, very helpful. Very helpful. So I know we just have a few minutes left, so we'll address this question last, and then we'll probably wrap at this. Drew, I'll kick this over one. This is a good one, I think, for you. So this is with in reference to the Secure Act 2.0. Should somebody consider donating from their IRA to a charity versus using cash?
Yeah, that's a great question. So when the Secure Act was implemented and the Secure Act 2.0, we're having a lot of conversations with clients around what's the most efficient way to send money to the next generation. And this is one of the things that comes up, because if you've built a pretty significant IRA or qualified plan that was moved into an IRA and you pass away, your beneficiary is not a spouse, because that's a marital transfer asset, but to say a child, you have a 10-year, now they have a 10-year rule to get that money out of there. So this kind of goes back to the balance here too. Do we defer a bunch, which we've been talking about today, but if we don't spend that down? So we're a lot of clients who say they're charitably inclined and they may be giving cash each year to a religious organization or not-for-profits or anybody they feel charitably inclined. That's cash they have saved versus saying, hey, let me take RMDs, let me try to get some of that money out of there to a charity instead of using my cash, because I'd rather pass cash as a more efficient asset. So again, there's this balance, and that's where financial planning really comes into. But that's a great question, that it could be a great tool to use to get maybe some inefficient dollars potentially to a charity versus some more efficient dollars. So great question. And just real quick, one component I wanted to add to the last thing Brian was talking about the children. If you do have a child, like say my daughter who's 16, and you're going to pay him 15, be very careful, right? We've run into the situation where, what if she gets a job at Chick-fil-A and now she's earned $2,000 for the year and I've paid her 15, I now have to file a tax return, right? So if your child is going to work or potentially could work, be mindful of that limit of the 15,000 for 2025. I just want to make sure we mention that, because we have had a couple of clients that, that happened to, and that can really cause some more paperwork.
Yeah, absolutely. Well, super helpful. I want to thank everyone for joining here today for the webinar. I hope you found the information valuable. Certainly, if you have additional questions regarding your situation, please reach out to any one of us here. We're happy to address any questions that you might have here or any follow-ups. And also want to thank my co-hosts here, Drew Allen and Brian Lydell, for their input here as well. Very, very good nuggets of information around this topic. So thanks everyone for participating, and we look forward to the opportunity in helping if you do have additional questions. Have a great day.